You know, when a market crisis hits, the first instinct for any investor is to run for cover. But what happens when the safe investment you ran to isn't quite what you expected? Well, today we're putting sustainable investing through the ultimate stress test. We're looking at the massive COVID-19 market crash and asking, did ESG funds act as a shield, or were they just another ship caught in the storm? Let's find out.
So let's set the scene. It's early 2020. Between February and March, the global market goes into an absolute freefall. The MSCI World Index, it plummeted by about 34%. I mean, just a staggering drop. In that kind of chaos, investors are, understandably, desperate for a safe harbor. And the big question on everyone's mind was, is ESG investing, this thing that had been getting so popular, is that the safe harbor? Or is it just as vulnerable as everything else?
To get to the bottom of this, we're going to dig into a brand new 2024 study that really put ESG to the test. These researchers took a magnifying glass to that crisis period, analyzing 24 different ESG indices to see, once and for all, if they actually cracked under pressure.
Okay, before we dive in, we need to be clear about what kind of ESG investing we're talking about here. The study focuses on a really common strategy called negative screening, and it's exactly what it sounds like. You start with a standard group of stocks, and you just kick out companies from controversial industries, like tobacco, fossil fuels, or weapons manufacturing. It's one of the most popular ways to build an ESG fund.
And believe me, this was no small-scale analysis. The researchers looked at 24 different indices from the real heavyweights in the industry. We're talking S&P, MSCI, and Dow Jones. And they looked at data from 2017 all the way to 2021, so they could get a full picture of what was happening before, during, and after that huge market shock.
So how do you even begin to measure success when everything's going haywire? Well, let's do a quick refresher on the standard tools investors use to check on performance.
It really boils down to two key ideas: alpha and beta. You can think of alpha as your performance score. Did your fund actually beat its benchmark? If you have a positive alpha, you're a winner. Beta, on the other hand, is all about risk, or what we might call resilience. It tells you how much your fund gets tossed around by the waves of the overall market. A lower beta means it's less volatile, more resilient when things get rough. Now, the standard way to do this, the conventional wisdom, is to take your ESG fund and just compare it directly against the entire market, like the S&P 500. Seems pretty logical, right? But this is where our story takes a really interesting twist. Because the researchers behind this study asked a simple but absolutely brilliant question that changes pretty much everything about how we look at ESG performance.
They just asked, when we compare one of these specialized ESG funds to the entire market, are we really making a fair apples-to-apples comparison?
What if, they wondered, instead of using the total market as our yardstick, we compare the ESG fund to its parent index? In other words, the original portfolio before all the controversial companies were screened out. Now, this might seem like a small change, but trust me, this is the key that unlocks the entire story.
Let's use an analogy to make this crystal clear. Comparing an ESG fund to the total market, well, that's like trying to judge how good one specific apple is by comparing it to every single piece of fruit in the entire supermarket. The bananas, the oranges, the pineapples, the whole shebang. It's a messy comparison,
But comparing it to its parent index? Now that's like comparing that apple only to other apples. Suddenly it's a much more direct, much more fair, and frankly a much more revealing comparison. And that's exactly what this study did.
And by making this one critical change, just by changing the benchmark, the study uncovered two completely different scenarios which gave two completely different answers about how ESG funds really behaved during the crisis.
So, let's look at scenario one. This is for those big ESG funds that are basically benchmarked against the whole market. And the finding here? They performed equally to the market during the crisis. This is a huge win for an ESG-motivated investor. It means you got to invest according to your values without having to sacrifice returns. The study calls this a positive surplus. You got your ethical goals with zero financial penalty. A total win-win.
Okay, but scenario two, this is where things get really interesting. This is for the more specialized funds. And here a very clear trade-off appeared. While some funds performed just fine, about half of them actually underperformed their direct peers when it came to returns. But, and this is the whole point, they also had lower risk. They were more resilient. So investors were making an implicit choice. They accepted slightly lower returns in exchange for a much smoother, more stable ride through that market storm. And this brings us right to the heart of it, the core takeaway of this whole analysis, this idea of a resilience trade-off. It really forces us to think differently about what performance even means when a crisis hits.
So let's wrap this all up. ESG performance during the 2020 crisis wasn't a simple they won or they lost. It was much more nuanced. When you compared them to the broad market, they absolutely held their own, which is a big surplus for ethical investors. But when you compared them to their direct peers, a fascinating trade-off emerged. Some funds gave you resilience, less risk, but it came at the cost of some performance. And that makes you think, in a crisis, isn't that resilience, that stability, a valuable form of return all by itself?
I think the authors of the study really said it best in their conclusion. They wrote, the negatively screened ESG indices either provide investors surplus for the ESG-motivated investors or being resilient to the crisis. It's one or the other. You got your ethical goals with no financial hit, or you got an extra layer of protection when things got crazy.
And that really leaves us with one final question for you to think about. When the next market storm inevitably hits, what do you value more? Is it the chance for higher returns, or is it the promise of resilience? The answer to that question might just define your entire investment philosophy.